you buy a $800,000 strata office 3 years ago in Melbourne, you could be down 50%.
Alex Groh is here. He's the founder of Vanta Advisory. And today, he's revealing why the golden rule of property investing
is actually a trap that's costing investors millions.
That's where I get really nervous in that space. If the budget's not north of $2 million, we shouldn't be looking at commercial.
Exactly. You're really seeing a drop in the quality of assets. You're getting a man cave type properties. It's not recession-proof.
The experts that should be giving the right advice are buying low quality assets with low quality tenants.
Yeah, the 6% number just baffles me. It's a golden number. If it's not 6%, we don't buy it. I just don't understand that methodology.
Looking into 2026, where's the best opportunities in the commercial space?
Industrial is still going to be a strong performer. Still looking at WA, South Australia, Queensland very closely. You want to sell to an owner-occupier who's going to pay
Arguably more.
That's what I say. You'll actually make money for tenant leads. Your downside is just you buy a $3 million asset, it goes vacant, you've just made $300,000. That's your downside.
The upside is you rent it for 10 years at a 6% return.
That's the hours of commercial property.
You're listening to the Follio Property Podcast. I'm Reece Beddall and I'm here each week with my co-host Lachlan Delahunty. Lachlan, we did it. We've launched the National Investment Report. There's going to be a link in the show notes. Scan the QR code if you're watching it on YouTube as well, on the TV. Got a special guest today. Maybe someone more controversial haircut than myself too.
Yeah, I'm the odd one out today.
We've got Alex Groh, founder, director of Vanta Advisory. Advocate for quality assets, which we see a lot of similarities between both what our values are, Lachlan, and what Alex's are. And he's in the commercial buying agent space. Welcome, Alex.
Guys. Pleasure to be here.
Let's kickstart, Lachlan, because we get through our business, and we're pretty focused on residential. We do get a lot of clients coming to us regarding commercial, and sometimes they're not actually in a position to go for that. Where do you see commercial from a strategy standpoint in a portfolio?
Yeah, it's all, well, you buy commercial, we've had Cal Doggett on here previously, and you're buying it for cash flow, where residentially, typically you're buying it for capital growth. So where does cash flow sit for me in a portfolio? Typically it's as you're getting closer to retirement and you want to replace your income. That's typically where it's most appropriate, certainly not for your first time investor, likely not for your second time. But as you go through the journey of investing and you build a portfolio and you build equity into assets, and often some of the properties we buy, recent residentially, are heavily negatively geared, and we want to flip that later in the journey to more cash flow positive assets. I think commercial is the perfect space for that because you can get quality assets, and I'm sure you'll talk about this, Alex, is quality assets where you get almost a guaranteed income, but you're not really banking in capital growth. Is that a fair assumption there, Alex?
Yeah, I think that's a good way to think about it. Typically, clients are transitioning from residential. As you said, they've accumulated their wealth in the residential market. Typically, commercial's not during that wealth accumulation. Of course, some clients will do really well and have a lot of equity uplift in that portfolio, but it comes when cash flow is critical and when you're looking at a portfolio and maybe you can't borrow anymore because you can't hold any more negatively geared assets. Perhaps you're looking to slow down work and you need some income in the future to replace your personal income. So that's a really good spot for commercial to come in. I suppose a caveat to that is it's not always a straight transition. I own 3 residential properties. I'm 50 years old and now I'm looking to buy a commercial property because I want that to support my retirement. It's not always that black and white. And often the case, it doesn't actually ever occur that way. At least that's how we see it at Vanta, because you have to be really conscious of good quality assets when it comes to commercial.
Are there people out there doing that? Like, would there be solutions for those clients at the moment? Like, are people putting those clients into commercial assets that you're seeing on the ground? Absolutely.
I think that's kind of where this commercial market really hit the ground running, probably 7, 8, 9 years ago, with those type of clients looking at your more basic assets. And listen, the markets have performed in some sectors incredibly well. And what you used to be able to get for $800,000, which is a lot of kind of mum and dad, first-time commercial investors, that's now probably $1.5 to $2 million. So that price point has jumped drastically.
That's where I get really nervous in that space. And when I meet with clients, I said, if the budget's not north of $2 million, which sounds significantly, we shouldn't be looking at commercial because of the risk profile or the tenancy profile that you attract under that $2 million. Is that a fair statement?
Exactly the way we look at it. We think $2.5 mil is really where you need to be. And even in that case, you're not necessarily going to get an amazing freehold on a big block of land in a capital city. But you are going to get something that's good quality. You're going to get something in a metropolitan market that, fundamentally has low vacancy, a big pool of tenants. And even when you do lose a tenant, there's going to be plenty more ready to go when that fills. Whereas when you're playing in that, call it $800 to $1.2 million range, right now where the market's at, you're really seeing a drop in the quality of assets. You're not getting
strata type assets.
You're getting strata, but you're not getting a good sized strata warehouse in a metro market. You're getting more of these man cave type properties, 100 to 150 square meters, which not
typically see people store their boats and toys in those sort of sheds, right?
It's not typically for a business to actually run a business from, right? It's a hobby investment. It's maybe a brand new startup business. It's not someone that's been trading for a few years.
It's not recession proof.
It's not recession proof, and because of how many buyers are in that pool and the push for buyers to get into commercial from a lot of these big players in the game.
So big buyers agencies you're referring to?
Big buyers agencies. These markets, they're flooded and they are so competitive. Transacting in these markets, I've never tried. I sit from the outside and I look in to see what's happening. And some of the results that sales agents are getting in these is incredible, which is great for the sales agents. Hats off to them, they're doing their job. But certainly if you're being represented on the buy side, going into these assets, I just don't see what the future is, where your income growth is going to come from, where your capital growth is coming from, and how recession-proof these are. Because a lot of these are getting built. When you're seeing a lot of sheds come out of the ground, you're seeing these type of assets get built. So they have the biggest threat of too much supply.
Looking into 2026, me and yourself have actually had a conversation when the beauty of your role is you're not wedded to one particular market and you can kind of maneuver where the best opportunities are. But putting, from a asset selection and location perspective, where's the best opportunities in 2026 in a commercial space?
I think industrial is still going to be a strong performer this year. We've come off the back of 5-6 years of unbelievable growth. There's a lot of different people that publish a lot of different stats, but there's a lot of people that say industrial's outperformed every residential market in the country over the last 5 or 6 years, which it certainly has in some markets. Do I think that 10+% compounding rental growth is going to continue? No, I don't. But are we going to still get good rental growth? Absolutely, because key markets have no vacancy. There's no stock to buy. And we know, as I was saying before, that owner-occupiers are really driving these markets. And like we see with residential, investors can push a market to a certain point, but then they're looking for returns. And if the returns aren't there anymore, then they exit or they just don't buy. But the owner-occupiers keep pushing. You're probably seeing it in Perth in residential now. A lot of owner-occupiers are now taking that market to the next level.
And that's where you want to be targeting, right? Like you talk about reducing downside risk. Residentially, we always target strong demand owner-occupier areas, and
Correct.
It sounds like you've got the same methodology.
The same thing, absolutely.
For commercial.
Because, again, if you lose a tenant, you have to sell. You want to sell to an owner-occupier who's going to pay
you more,
that
arguably
emotional
more.
price. That's right. So industrial, I think, is going to have a good year. Metropolitan, we're still looking at WA, South Australia, Queensland very closely. I'm from Melbourne. I think there's green shoots for the Victorian industrial market. I don't know if they're coming now. And my advice to anyone looking at Victoria is it could get a bit worse before it gets better, or it's just not going to jump as quick as some may think.
Yep.
But again, diversification play, parking your money, long-term wealth preservation, plus the potential upside that we have to get at some point. We're the biggest industrial market in the country. We've got the lowest rents of anywhere in the country. Even regional towns like Townsville are seeing higher rents than we're getting in core markets in Melbourne.
Right. That's the opportunity, right? That's why we took a position in Melbourne in a residential sense, 12 months ago when it was the same sort of problems, right?
Correct.
It seemed ridiculous how low rents were, what median house price were, etc. So
absolutely. So I was saying to Reece earlier, commercial typically has some relationship with residential. I found that it typically moves a little bit later. So there's this 12-month lag period, 12 to 24-month lag. So we've seen residential in Melbourne start to kick. I think we're a touch early for, industrial and retail and office. We're certainly early for office. I wouldn't be touching office for quite a long time. But industrial and retail could still be another 12, 24 months away. But park some money. I'm not going to say take a risk, but take a position where you may not get that growth in a quick period of time. And I think you can't go wrong with Melbourne.
Good. And then just to suppose that's the upside where you see the risks that probably correlate with some of these other big buyers agent conglomerates on the East Coast that are buying strata.
Yep. Yeah, I see the risk in office. I've seen a lot of New South Wales entrance into Melbourne office markets. If you're on the ground in Melbourne and you have any knowledge of anything to do with real estate, you are not going anywhere near office. It has to be, we're talking like maybe at a 10% yield. As I've said, write-downs on office have been 40 to 60% on some office. And we're talking some of the big like $30, $40 million buildings have halved in value. And that's continuing. Like the office vacancy
growth
is the highest in the country in Melbourne. It's just not a market I'd be going anywhere near for a long period of time. We have to have some real structural change in Victoria
the office space.
and the office space for that to be appealing. Unless, of course, like I said, 8, 9, 10% yields, maybe that's enough to take a risk. But 6% on an office asset in Victoria, it's just crazy. I would not touch it with a 10-foot pole. You know, retail, other markets, there's probably maybe greener shoots for that. But again, retail is going to be heavily affected by what's happening in the interest rate environment.
Yep.
You know, as you said, 2, 3 rate rises could be on the cards. The discretionary
Surplus
spending
comes down.
That's it. And what's going to be affected? Strip retail.
Yep.
Those type of assets. But yeah, I don't know where it came from. I don't know what made this, 6% the golden number. It's what I'm seeing out there. It's kind of, if you see 6%, nothing else matters. It doesn't matter the asset quality. It doesn't matter the tenant quality. It doesn't matter what's happening next door. If there's going to be 20 more of those same properties come out of the ground in the next year. If it's 6%, it's 6%, and we got to buy that thing. I don't know where it came from. I obviously understand you want to try to beat the current interest rate, but yeah, the 6% number just it baffles
it's
me.
now the golden number.
It's
that's
the golden
relied
number.
upon.
If it's not 6%, we don't buy it. And I just don't understand that methodology, because when we're looking at an asset, the yield's important, of course. People are buying commercial for yield, but the yield on day one isn't necessarily yield over 10 years' time, right? You take a 6% yield to a karate studio that's probably paying over market rent. They probably have some illegal mezzanines installed. But
Or they've probably put huge incentives at the front end where we'll fit it out for you that wasn't factored in, but on paper value.
That's
so
right.
those listeners' incentives.
Yeah, you might sign that tenant for 5 years' time, and you might say, listen, I'll give you 12 months rent free. So 12 months rent free on a 5-year lease is a 20% incentive. You're probably getting a bit less than that for industrial, and we're seeing office incentives up 50, 60% in some markets. But you as the owner, you'd sign up that lease, you'd pay that out up front, call it 50 grand, 60 grand, you'd just give that to the tenant.
Part way from that. Yep.
And you'd go to sell it, and you'd sell it to the incoming buyer at a 6% yield. They're not paying for that incentive. They're getting the full rental for that whole period of time, but they're getting 6%.
Is that quite common then on most commercial deals? There's some sort of incentive there?
Yeah, definitely. Like I've got a deal right now that I'm acting as a vendor advocate for on a blue chip suburb. It's an office asset in Victoria. Blue chip, one of the best suburbs in
Whereabouts
Victoria.
specifically?
It's in Hawthorn.
Yep.
It's a good office. It's a top floor. It's got a balcony, really nicely natural lit. We're trying to sell that vacant at the moment to an office occupier. We can't get it away to save ourselves. We're getting offers. We'd love, mid ones, call it 1.6. The best offer we're getting is 1.1, 1.2. There's properties in that same complex right now that are selling with leases in place to some of these bigger buyers agency groups because they have a 6% in front of the yield, and they're selling for the same rate that we're asking for this building. So
we're talking a $400,000 uplift purely
by signing
because
a lease.
signing a lease that the perceived 6%,
Correct.
regardless of incentives.
That's right. Yeah.
So
that lease is not, leases are they're legal agreements, yes, but you get a tenant in there and that they go bankrupt. You might get a 3-month guarantee out of them, but all of a sudden you've lost 400 grand value in your asset. And then you've got to lease it up, and you're looking at this particular market, a 6 to 9 month leasing up period.
So it could be vacant for at least 12 months sometimes.
It could be
often.
easily, and then you're looking at a 30% incentive, which you're typically going to have to cough up front. You could be up for another 100 grand on day one in fit out works, in rent-free periods. And that's probably the most critical thing we look at when we're buying is assets, not the yield. What's the downside, and how do we protect the downside?
Vacancy risk, really.
If it goes vacant, what do we do? If a tenant leaves, what's the strategy? Is it to release? Is it because a lot of our clients are not in commercial to accelerate wealth and accumulate wealth, as I was saying. They're there to preserve wealth and draw an income from it. So the worst thing you can do when you're trying to preserve wealth and draw an income is lose wealth, is lose money because you bought a shit asset that the tenant goes and you can't lease it, and then you're in a distressed position and you need to sell it well below what you bought it for. That's the absolute worst case. I'll take an alternative asset as an example, and you can probably put a blanket over the entire industrial market around the country. You buy a warehouse with a lease in place. If that tenant leaves, you are almost certainly going to sell it more than you paid for it as an investment, because the owner-occupier market is so strong pretty much across the whole country.
For the larger sort of industrial
For
format.
the larger stuff, you're talking, probably 500, 600 square metre plus
So
warehouses.
from a price point, 2 million above.
Exactly, yeah.
So
That's
they're
right.
better off selling vacant to an owner-occupier who will pay a premium
Correct.
than the investment space.
And clients always say, what if the tenant leaves? And
That'd be a good
say,
thing.
that's what I say. To be honest, you'll actually make money if the tenant leaves. We're not going to sell necessarily, because we want to hold these commercial assets forever, pass it
But
through
that's
the
your
generation.
downside
That's
risk.
your downside. Your downside is you buy a $3 million asset, it goes vacant, you've just made $300,000. That's your downside.
That's your down. The upside is you rent it for 10 years
Exactly.
at a 6% return.
That's right.
And then when you sell it, ideally it's worth a lot more than you
5,
paid.
6 mil, who knows?
Yeah.
And so the protecting your downside is one, in that owner-occupier demand, and two, you're buying an asset in a market that you're never going to have to sell it in that situation, because you're going to get a tenant. There's going to be tenants knocking on the door from day one, ready to lease that property. So your vacancy time is going to be minimised. You're going to actually be up financially. You're probably going to get a higher rent than you were getting previously.
What's probably most concerning about this space, because what I'm hearing is you can lose money in commercial property, and it's arguably the most risky space to enter as a unsophisticated investor.
Mm-hmm.
And I think that's probably why there's been such a surge in the reliance on buyer's agency, because residential, we all lived in a home, whether that's rented or bought a home. We know what to look for. Typically, broadly speaking, in residential property, there is unknowns in commercial real estate. So then we lean on experts to navigate us. But what you're telling me is the experts that should be giving the right advice, the buyer's agents that should be getting the assets that's going to be suited for my portfolio, are buying low-quality assets with low-quality tenants that, for me, spark speculation, but also high risk, and the likelihood of losing money is quite probable.
Well, that's all I can speak is what I'm seeing in the conversations I'm having with, one, clients, but two, their trusted network, their brokers, their accountants, their financial planners who have had clients in these positions. And I'm seeing it on a daily basis. If you've spent $800,000 on a house, pretty much in any suburb in Australia 5 years ago, for the most part, you're probably up. You're probably not down.
Yep,
You might be where you are. If you buy a $800,000 strata office 3 years ago in Melbourne, you could be down 50%.
50%.
50%, and we're seeing that's not only in that space. That's an issue of the state, Victoria, what's happening in the Melbourne office market. But that's
the risk of commercial real
That's
estate
the risk.
if you're not informed or don't have
Absolutely.
qualified advice.
Absolutely. And the assets that are getting bought today, that I don't think there's any upside. All I can see is there's potential for downside. I'm not saying they're all going to fail today, but on the surface, what we're looking at is, can you protect your downside in these assets? No. Is there any upside? Absolutely not. So the only option is downside. So if I've got some examples here in the Gold Coast, $6,000 a square metre on a 130 metre building, a 130 square metre warehouse at a 5.5% yield.
5.5%.
That tenant's paying $350 a square metre rent. That's like, you're talking prime Sydney suburbs are paying that kind of money. But $6,000 a metre, you just think about how much money the developer's making. And again, hats off to them. You're picking up land for, mid-$1,000s a square metre, you're putting a shed on it for $2,000 a metre. Like, that's an unbelievable profit margin for the developer. And, developers have to make money. They've got a role to play in this market. But I certainly don't want to be buying these assets for my clients, which have almost no chance of making money, and we're just making money for the developers.
Yeah. So when I look at it, so just like zoom out, because we buy, typically you said you buy commercial for cash flow with potential for capital growth, residential typically for capital growth with potential for income. And this is very broad speaking, but normally it's residential 6% capital growth, ideally 4% yield, and then you flip that with commercial.
Yeah.
You look for 6% thereabouts.
Yeah, mid 5 to 6%, and 3 to 4%
in terms of yield, and then you might get 3 to 4% growth.
Correct.
They're forecasting, broadly speaking, 3 interest rate rises this year. Where are we currently sitting at for interest rates? It's about 5.5.
For actual
Cost of debt.
I mean, probably could be early 6s for commercial.
Now?
Commercial's always a touch higher.
Resi's like high 5s.
Okay, so we're currently sitting in early 6, Alex, for commercial debt as we speak.
Yep.
By the end of the year, that could be mid 6s.
Mid-6, 7,
Could be 7%. And yet this golden number of buying commercial property at 6% yields, all of a sudden we're buying commercial, or people are advising to buy commercial that's negatively geared when you buy commercial for cash flow.
Yep. Well, I think that's a really good point. These assets, the issue with that is your big assets, they're not necessarily going to suffer. Your tenants aren't going to suffer the way that, in a rising rate environment, you think of the businesses that could suffer and where a client's not going to spend money, where a consumer's not going to spend money. There's a nail salon in the ground floor of a large apartment building. That business is going out of business before a large...
Or Jim's karate studio.
Or a gym, a karate studio. Discretionary spend goes down. These businesses suffer. So that 6% yield, all of a sudden goes to 0%. But then the tenant market after that's probably softer. Now you're looking at $300 a square metre might come down to $250. So that 6% on day one, after 12 months, it could be now it's 5.5%. And 5.5%, you could have not done nothing, but you could get, with more money, a really, really good quality asset for 5.5%. So
it's interesting, and that's where people have to be really cautious and make sure that they're represented correctly, because it's a dangerous space when you're talking about you can lose 50%. Who in the last 5 years has lost 50% in real estate?
In residential, I can't think of anywhere.
You can't. So
you could have bought in the worst areas in the country, and you would have certainly not done that.
But we've sort of gone quite a negative tone towards commercial property. Let's talk about where it does make sense.
Yep.
And like I said, for us, it's the right clients when we can get. We've accumulated a portfolio and cash flow becomes more important than capital growth, and it's typically later on in the investing journey where we're starting to get out of this rats and mice, low quality tenancy, sub $2 million space, and we're getting really blue chip tenants that, the likes of the extreme versions we're talking about. Imagine having a Bunnings tenant or a Centrelink where you're backed by the government. Yep. Why is that important for the novice listener in terms about tenant quality? Because most people out there that are signing up to these buyers agencies that are getting 6% returns didn't realise that Jim's karate studio wasn't a sure thing. They thought that 6% is guaranteed for the next 6 years. Yep. Sorry, it's not. So what's a good caveat?
Well, I think
Covenant, caveat? Covenant. What's a good covenant?
Good covenant. Listen, I agree with what you're saying. I almost try to think about it in a bit of a different way to, let's buy a Bunnings warehouse or let's buy whatever with an A-grade tenant. We always peel it back to let's buy the best quality asset in the best suburb we can get access to at a $2 million plus price range. Because let's say you got an asset side by side. You got a bulky goods centre on a main road, blue chip asset, great improvements.
What's bulky goods?
Bulky goods, it's like a Bunnings or like a boating, camping, fishing, super cheap auto.
These big sheds that are...
It's a big shed on a main road that a large retailer will go in.
Okay.
You buy that asset, and let's say you buy it at, a 6% yield. You could buy that same asset next door, leased to a blue chip tenant like a BCF, and that could be a 5%. And the only difference there is the tenant. It's the same property, side by side. So I'd much rather buy the asset that is really good in terms of location, quality.
The fundamentals are the same.
The fundamentals are the exact same, whereas where you can really easily add value in commercial, there's a lot of ways, but one of them is get a really good tenant in there, because the incoming purchaser or the value is going to look at that and say, BCF is more secure than, Jim's Karate or Jim's Play Centre, whatever that is. But
let's get Jim out. Let's get Jim out.
Let's get Jim out and put BCF in there.
Yep.
And let's go from a 6% to a 5% yield. And all of a sudden, you're talking hundreds of thousands of dollars in uplift.
And Alex, we've done quite a bit of work together over the years, personal and professionally. Talk us through some examples of that same situation where you've been able to get, example comes to mind, $1 million of uplift essentially overnight by doing that.
Yeah, so we had a really good client of yours. This was a bit of a different scenario, but similar. One of the powers of commercial property. We bought an asset in Queensland in Willawong. It was a concrete tilt panel warehouse. Willawong is a great suburb, super low vacancy, established, no future supply coming. All the ticks that you guys look for in resi, the same stuff that I look for in commercial. They had a lease that was expiring roughly 6 months post-settlement.
Which would scare some of these.
And it's not for everyone. Yeah. This is important. And not everyone can buy that asset, one, from a finance point of view, because if you're pulling equity out of your resi portfolio, you're funding this with equity, so you're pretty much 100% debt funding this purchase. The valuer, in all likelihood, is going to say, we're not funding this, or the bank, we're not funding this asset because it's only got 6 months left on the lease. So fundamentally, like a really well-located asset in Willawong, no threat of future supply because it's fully established. Concrete tilt panel, which is what tenants are looking for, and That's more important in some markets than others. Like Queensland, it's important. When the market's going good, everything trades the same, but when it's going bad, there's a flock to quality. And
so reduce your downside risk by doing that?
Reduce your downside. If you're a tenant, you want a concrete warehouse compared to a tin warehouse, because when it's 40 degrees and 80% humidity, we'd rather work. But this, again, it's you being picky in a good market. This lease was expiring in 6 months' time. We had really good discussions with the tenant, and they were almost a sure thing to re-sign their lease. And the market rent was, or the rent that it should be achieving, was about 40% more than it was currently achieving.
Okay, significant.
Because the market moved a lot, they were coming to the back end of a 5-year lease, 4.5 years through their 5-year lease, and it was going up by 3.5% every year. But the market in the background was doing 7, 8, 9, 10% a year.
Right. So
that's where you get that discrepancy. So it's what we call rental reversion. And we were really confident they were going to renew. They had a big contract coming up. They leased a property next door. They leased a property around the corner. So really well embedded. But still, there was risk. We did not say to the buyer, this is a sure thing. What we did know is, worst case, these tenants let us know they were leaving. We had a 6-month window to lease up that property because we're buying in a blue chip area. Good fundamentals. We're going to get a new tenant in there. Sure thing.
And paying the new market rent.
Exactly. So the downside was maybe, just maybe, you had a little crossover.
It's not this tenant, it'll be someone else.
And maybe you get a couple of months of vacancy. But the upside, you look at a couple of months of vacancy, I was getting maybe 200 grand a year, call it 40 grand downside. The upside's 800 grand to $1 million in terms of new rent, reset the value of the asset.
So that between essentially purchasing that asset and settling that asset, extending the lease term of the current tenant, you created $1 million of wealth for that client overnight. And what was the purchase price?
2.4 mil. And
so it's a very palatable for a sophisticated investor with a larger portfolio. $2.4 million is quite achievable.
That's right.
So it's not 4, 5, 6 million.
Yep.
And you've created $1 million of value.
That's it.
Overnight by simply finding that opportunity. And what I found interesting about that, the larger buyers agencies that dominate New South Wales wouldn't have bought that asset for their clients.
Too low lease, it's too risky. It's only got 6 months. We're looking, and the initial, importantly, to this point, the initial yield we bought it at, and remember, this is only for a 3 to 6 month period, the initial yield was about 4%.
So it wouldn't have hit their beautiful 6% logo?
It wasn't 6%. It was 7% within 6 months, but it wasn't 6% day one. So,
And is that what you're saying out there with these buyers agency? They're purely focusing on that 6% yield?
Yeah, listen, I think it's funny. I've certainly started talking about this for quite a period of time. I'm not saying I'm a trailblazer in the industry and I've set some type of thing for everyone to follow, but I've certainly seen a change. There's some big groups that are still, we only care about yield. 6% is the number. Maybe now they're dropping the standards to 5.75, but it's still heavily focused on yield, and then asset and tenant quality comes secondary. But there has been a shift from some other groups that are looking at these ideas, and yes, commercial's there for cash flow, but they're also looking at it saying it's good for cash flow, but some clients don't need cash flow day one. Some clients can wait 6, 12, 18 months to get above market cash flow and also get capital growth. They just need to take a little bit of a hit in the short term.
And that's exactly the example that my client was willing to take with you. And that was just over 12 months ago.
That's right. Yeah, we had another example a couple of years ago in Queensland, bought quite a large asset, 3,500 square metres, a big industrial property for about $5 million. And if you just run your head around those numbers, you realise that you just can't buy anything anywhere near that. So those are the good old days. But we had that asset. It was about $100 a square metre. When we bought it, it should have been getting about 120. So we had a market review in 12 months. By the time that market review actually came up, it ended up achieving about 140. So that asset went from $5 million to $8 million in 12 months.
So they're the positive stories and how to run the commercial market, right?
That's it. And that's what those all have in common is the same thing. Good quality assets that appeal to a wide range of tenants in metropolitan locations with no additional land for supply. Like that's just a common theme that the ones that perform the best all have those same things in common. Same with residential.
What about on regional? So we've spoken about the key difference between certain regional towns and what do you call it? A metropolitan
region. So they got access to a CBD, larger CBD.
Yep. Larger CBD. Is that, from your perspective on commercial, is that the same, in terms of asset selection?
Yeah, I look at it similarly. There's in resi, sometimes you can do really well of buying in these smaller towns. We've seen it.
If you time the market to perfection.
We've probably done it. We've all done it ourselves. We've got into these markets. We've bought at the low. We've ridden it, but then we've got out. right? And that's the biggest thing. We've got out of this asset because we know
time.
it's not always going to be all rosy and it's not going to be 10% growth every year or 20%. So you exit, and that's okay for resi because you're accumulating wealth. That's what you're doing. You maybe you're flipping some, you got some long-term holds, but that's a quick way to accumulate.
We use regional almost like stepping stone assets for quick cash wins, right?
Quick cash wins. Hold it for a couple of years, pull out 200-300 grand.
Throw that off your primary place of residence or reload into another market.
Exactly. Where commercial, the clients I'm working with and want to work with, they're not doing that. They're, as I said before, they're parking money into commercial as a long-term wealth preservation, income generation strategy. So we're not going to come in and out of assets every 2 or 3 years. And that's where you've got these issue with the regional markets that aren't tied to big metropolitan markets. You're coming in, yes, you might get a 6% yield day one, but industry turns, and then what? Then that 6%
you can't sell it, and you may not get a tenant.
You can't sell it. You're not going to get a tenant, and the only way you're going to get a tenant is if you drop your pants on the rent and lower it by 30%. And now all of a sudden that 6% is 4%, and you've lost 30% value. So now you've got a 4% asset. You might have had 5 good years of 6% yield, amazing, but then the market turns, and now you're at 4% in, who knows, I don't know, Townsville. So I don't want to shame anywhere, but Townsville. Do you want to hold a 4% yielding asset in Townsville? No, I don't even want to hold a 6% yielding asset in Townsville.
I don't want to hold anything in Townsville.
Exactly. But why am I buying at 6% in Townsville when I can buy at 5.5% within 25, 30 Ks of Brisbane? I don't understand. You're talking 50 basis points, on a $5 million property. That's marginal income per year. That's not life-changing income. That difference.
You better put that in the bank. If you're looking for cash flow, you're going to get a better and a safe return.
That's right.
As safe as it can be.
Yeah.
Beautiful. Thanks for coming, Alex.
Pleasure. Thanks for having me, guys.
You've been listening to Follio Property Podcast.